All right. Eric, hey, we really appreciate you being here. Excited to kind of dive into this topic.
Yeah, well, make sure. Thank you for having me. I really appreciate it. Always love
Absolutely.
talking to you guys.
Absolutely. Eric, we've got you kind of founder of Martel Turnkey. But before we kind of jump into that, man, share a little bit of background with our listeners. You've got a very interesting job that you held at one point. I'd love to hear about that, but then also how you got into real estate.
Yeah, I mean, the first real estate deal that I did, I actually did it. I was when I was 18 years old, so just still at university, and I had met this guy. This was really my rich dad, poor dad moment. I
Mm.
had met this guy that was a real estate investor, and he had like a 36 unit apartment building. He was planning to build a shopping center. He was planning to build a nursing home and all of that. And well, that's fine. But this guy was a regular community college teacher, and I was just like, "What? You're just a I don't
Just
want
a
to say it
teacher.
that way. You're just a teacher, like you know." So and that really, yeah, I kind of compared him with my parents, and that they were living paycheck to paycheck, kind of like what most people in the previous generation, and having barely no savings. And here he is, this guy, same age as my parents, but he was no smarter than my parents. He just had more knowledge about investing, about he was just smart about money and how to make things happen. And um, and he also had like a discipline about going after his goal. On every day he was taking a step closer to his goal. So that was kind of my first kind of like real estate deal. As soon as I met this guy, I said, I'll just teach me. I'll do whatever you want me to do. I'll just follow. And that basically it. I mean, I bought the 8 unit apartment building. When said I wanted to kind of like invest in real estate, I said, Craig, I mean, I don't have any money. I'm a student.
That's what I was going to ask, man. You're a
Uh,
college student.
and he said, don't worry about that. It's just like, find the deal and we'll figure it out. And secretly, I thought that he would actually be investing in my deal, or that he would figure out how to convince my parents to invest in the deal, or there was some kind of thing like that. So I pushed forward, and I ended up building that apartment building. No money down. Basically, 80% came from a credit union, and the other 25% came from the vendor as a note. What they used to call vendor take back, but a promissory note on the back end.
Mm.
And that's it. And I'm very happy that I didn't have my friend investor, and I didn't have my parents involved, because this really showed me, which was the whole reason why I did this in the first place, is that I could do it on my own. I could make an investment that generates cash flow, without having this me having to work at the job and all that kind of stuff. So that was my first test. The thing is that I did it not for achieve financial freedom and stuff like that. You're 18 years old, you're not thinking that far ahead. And I just did it because to prove to myself it was just another thing to do, and it worked. But it really changed my mindset about money, how to make money, what a job is, and all that kind of stuff. After that, I always had a very loose relationship with job compensation, all that kind of stuff. I could work on contract, work on W-2, do this business, and all of that. So so that's kind of how I got started. But I was at university to be an actuary,
Mm.
and eventually graduated and started working as an actuary. And for those of you
Sounds
who don't
exciting.
know, yeah, for those of you who don't know what an actuary is, it's really a mathematician that specializes in financial risk. And so I worked as a consulting actuary and associate actuary for 10 years, close to 10 years. And my job every day was to what they called wind down a pension plan. So there's like basically two different types of pension plan. There's defined benefit pension plan and defined contribution pension plan. And defined benefit pension plan is really when your retirement benefit is defined up front. And then your employer is responsible to fund, to have enough money at the end to pay for that pension. So the defined benefit pension plan would say, for example, that if you work for me for 25 years, I'm going to pay 50% of your final salary. And that's what you're going to get for the rest of your life. I'm going to pay 50% adjusted with inflation. And I'm going to pay that at retirement. That's defined benefit. And the employer has to figure out how to invest the money, and whether the stock market goes up or down or whatever, they have to figure that out. And that's, when I talked to a group of people, a conference in Los Angeles last month, and then I asked people. I had different groups, like they had like Gen Xers, I had Boomers, I had Millennials, and I said, anybody knows what a defined benefit pension plan, or nobody knows, because in 30 years ago we did such a good job at destroying that perfect retirement plan, and then everybody was moved down to basically a 401k, where now as an employee you have to figure out how to invest your money, how much money you need to save in order for you to retire comfortably. And who knows how to do that? Who knows how to calculate that? Well, an actuary, which is, but not many people are actuaries. So how do you figure out, how do the normal people figure out how much money they need to spend, save, I mean, and how much money they're going to need at retirement? So that's the critical portion, and this is why we're just getting started on the most critical, or the biggest retirement crisis we're gonna see. It's not gonna be good, because a lot of the boomers are just getting started into the retirements. We're probably about like 25 or 30% of them have retired now, and probably 10% of them are actually working at Walmart as a greeter. But but that's the critical part of it, and I think that's what people need to think about upfront.
Eric, what years were you kind of employed when they were kind of switching from defined benefit plan over to 401ks?
So that must have been in the 80s, yeah, 80s and 90s. So yeah, and basically now all the pension plans that have been canceled or converted to 401k.
Were you privy to any of the conversations that kind of was happening internally at these companies, that they,
Oh yeah.
the ones that were defined benefit that were switching over? What were some of their concerns when they were essentially shifting this risk over to the employee?
Well, it was the cost. I mean, they never knew what the cost of the retirement of the thing would be. So at the end of I think it was every three, there's a cycle. Every 3 years, the actuary would do a report and make sure there was sufficient reserve on the for the pension plan. So we would look at everybody in the pension plan, what their age were, their salary, and all of that, and we tried to calculate, how much money was needed in the pension plan in order to be solvent and to have enough money. And every once in a while, like, you had employers that had like a surprise, and they say, "Oh, by the way, you have to write a check for $10 million or $50 million." I say, "Oh, what? What are my options?" Well, there is this clause in the pension plan where you can wind it down and just say, "Screw it, I'm gonna pay everybody out, and then you figure out on your own." And that's basically what happened. There was also a lot of regulations that came in when they were forcing employers to actually index the pension plan with inflation. So that increases the cost significantly, and this is why a lot of employers had like a major surprise at that point.
Now, Eric, I want to go back to something you had mentioned earlier about kind of the state of where we are, or this retirement crisis. But if we kind of look back, the stock market historically has been high. We've had historically low interest rates, low inflation.
Yeah.
We have all the financial things that should make it great financially, but you're saying that's not the case. You mind helping Cameron understand that?
Yeah, well, I think people didn't save enough. That's exactly what happened. I mean, the average retirement saving for people that are 55 years old is like, is $50,000 or $60,000, something around that range. Actually, maybe it's a little bit, maybe it's like $80,000. But still, when you're trying to, let's say you assume that you have an average salary in the US of $72,000, well, you're going to be able to retire for 1 year and maybe an extra month, like 13 months, assuming that. So that's definitely not enough. If you look at when people are retiring right now, you kind of think if you're invested in the stock market, you have to look at it and say, well, there's the 4% withdrawal method that they use often to calculate how much money do I need to save in order to live off my investment. So and that's 4%. That's the 4% method, and that is 4% of the value of your portfolio. So if you have $1 million in there, you're gonna be able to take basically $40,000, out, and then you're gonna pay some taxes and some fees, and then you're gonna be left maybe with like $35,000. Let's say to make it easy. All right, so that's where you're gonna be. But so that's how much you're left at the end of the year. Well, so how much do I need in my savings account, in my 401k, in order to afford $72,000 a year? Well, you need like $2.3 million or something like that in order to make that happen. So, I ask again, when I talk to people, do you have $2 million in the savings account in your 401k? Of course, almost nobody has that kind of money, right? So it's like maybe the top 1% or 5% of people have that kind of money. So the thing is that there is a better way for people to invest now, and then to build that cash flow, that passive income, and they may actually be able to retire earlier than what they anticipated, assuming you give yourself enough time.
Let me just summarize what you said. If you are astute enough to have accumulated $2.3 million, which I don't think a lot of people have, to be honest,
No.
but then to be able to accumulate that much wealth and then live off $75,000 a year,
yeah, exactly.
That ain't going to cut it.
There's a disconnect, right? Exactly.
That's why we're saying that Wall Street's rigged. I mean, we have to look for outside of Wall Street, right? And if, we've talked about financial freedom, passive income, more than monthly expenses. That's what we need to start focusing on. So, Eric, how can we get there?
So the best way to get there, and I just want to say also the 401k. So you were talking about.
We can take as much time as you want to poo-poo on the 401k.
401k is totally rigged. I mean, a lot of people are thinking, oh yeah, well, I want to retire. I'm going to put that money there. It's great. It's tax. There's some tax advantages and stuff like that. There are other investment vehicles that don't have the constraints of a 401k, but that have the tax advantages, and in fact, even more tax advantages than the 401k. So that's one aspect of it. And then, I forget where I was going with that. But so that's the thing. So what are some of the investment, the ways for people to invest in order to build that passive income? Well, if I'm gonna kind of like start with, I like to say the blank canvas, right? So let's start with a blank piece of paper or blank canvas and say, well, I want to have, let's just dream here. I want to have something that I can put some money down and have a bigger asset that's going to generate cash flow, that the mortgage is going to pay itself. I'm going to have great tax advantages. The cash flow is going to increase over time. And, that's going to build equity. And I'm going to have tax advantages. And, and then everybody, wants to stop me at that point and say, well, yeah, that doesn't exist and stuff like that. But it does exist. It's real estate. It's cash flowing rentals. And that's what people need to invest in. You have all these advantages that are built in. The tax code is basically built for real estate investors for the most part, maybe gas companies also, but basically for real estate investors. So if you don't invest in that, you can complain all you want that the system is rigged and all of that, but that's because you're not using the system the way that it's built. And everybody can go and take advantage of these advantages of real estate investment, the tax advantages and all of that, and get started right away. And the easiest way to get started, in my opinion, is single family rentals.
Why is that the easiest?
I think it's the easiest, and I think it's also the most what's the word? The most flexible, because you can build your passive income portfolio over time. So you go and look online for turnkey rental providers. So these are companies that they have bought a distressed property, they renovated it, they put a tenant in place, and now you get to basically buy that properties that's cash flowing. It has property management in place, and you don't have to worry about it. And you can build that portfolio relatively quickly. Also, the single family rentals, the returns on the single family rentals are they're a lot more attractive than the multifamily right now. So, which is kind of like the other alternatives. But keep your eye on the market. But right now, the multifamilies are very expensive, which means that if they cash flow, they're going to cash flow maybe around the 5-6%. That's the cap rate. Once you include the mortgage, it's going to drop down. If they cash flow, it's going to drop down maybe to 2% or something like that, but maybe 4%. So it's not really that attractive. And then when you're looking at it with a single family rental, it's a lot more attractive. And because there's not so many people that are buying single family rentals for some reason, even though I've been talking about it for years. But it's a great investment. The cash on cash return is much higher. You get the appreciation and all the advantages associated with that. And you can do the same thing later on. Like if you want to kind of like the 1031 exchange, if people have heard about that, I mean, you can go and use 1031 exchange and take advantage of that and buy a bigger property later on. Or that if you want to go into multis, that could be a good way for you to go into that level. You also have, if you decide to divest at one point, you also don't have to sell the whole apartment building. You can just sell one house, or whatever. Another strategy that I talk about is also to live off the mortgage, live off the money. So let's say you bought a property, 30 years from now or 25 years from now, and now you're ready to retire. You have 30 properties in your portfolio, and then but some of them are paid off already. So you could take a mortgage on one of those properties, have still that property cash flow, take the money out of from the loan and live off of that. That's not considered income. That's not taxable. That's a loan on your property that's being paid by the tenant. It's still cash flowing, and now you have money in your bank account that you can go and travel and live on. Lots of flexibilities, all kinds of things like that you don't necessarily, when you work with a bigger asset like multifamily, you lose a little bit of that. Flexibility. There are great things about multifamilies also that I really love, but I think especially for the beginning investors, I think single family is definitely the best way to get started. And also you're in control. A lot of if you cannot buy a multifamily on your own, the next option is for you to be part of a syndication. You don't have the control then with the syndication. And I like to be in control of my asset and be able to do all these things that I've been talking about. And and you can do that with single family rentals.
Eric, now, if I remember, you didn't start in single family, right? You started in multifamily.
Yeah.
When or how did you make that transition? And then if you can, lead us into kind of Martel Turnkey. How did that come about?
Yeah. So, I mean, the 8-unit apartment building is what I bought when I was 18 years old. After that, I was trying to replicate that and do more of these kinds of investment. And it was very, very hard. It's very hard to find these properties. And it was also, and I thought, oh, well, maybe I need more money. It's always about, people always identify the number one problem as being money. And it's not really that. It's time, and it's being able to find the right, networking with the right people, having the right resources. These are the things that are very critical, because the more time you have, the more time you can be on the phone calling people and start sharing your opportunities and finding money. So time is the key, and resources, being resourceful, is the other thing. So I was trying to get other multifamilies. It was very difficult, and I moved around a little bit, worked as an actuary, and tried to build my nest egg to do that. Moved to San Francisco, and I had like tons of stock options at that point. I was working for a high tech company. Moved in 2000, and I thought, okay, well, this is it. I can try to find. I have enough money now. I have so much stock options and so much money. I mean, I could buy things. I can buy like apartment buildings and stuff like that. But then, and I was looking for those, but then they wouldn't cash flow, first of all, in the Bay Area or in California.
Yeah.
And then they would, if I wanted them to cash flow, I had to put so much money down that the cash on cash return was like ridiculously low. It was like 1%, 2%, 3%. So I said, well, I better keep looking. And, so I kept my money in the stock market. And then we had the dot-com crash. So I lost like literally millions of dollars in that stock market crash and these stock options. So that's like, okay, start from square one almost. And it took a while, but then I kind of like, I was still trying to find deals in the Bay Area and try to do all kinds of things, wholesaling, blah, blah, blah. And really, it's only like 10 years ago, 10 years ago, approximately 10 years ago, that, we kind of like, I went into the single family again. I started looking more into the single family rentals, but it still didn't make sense in California. I said, well, okay, where does it make sense? Where can I find single family rentals that do cash flow anywhere in the world, or anywhere in the US? And then this is when I kind of, I looked at, I want to be in a landlord friendly state. I started putting some macro criteria to identify the best market for this kind of real estate. And landlord friendly, as I mentioned, sustainable growth, boring cities that don't grow that much. They're not like nobody's talking about them. You go to a real estate meetup and nobody's talking about your market, because they're all talking about Phoenix and Austin and all that kind of stuff. And then so that's kind of what I looked at, and I ended up investing in Memphis. That was the first market where I bought a property. I did basically a BRRRR strategy at that point, and it worked out great. I had bought the property, did the renovation, put a tenant in place, refinanced it, got all my money out and then some. So now I had an asset that was cash flowing, and I had more money in my bank account than when I bought the property. And I was like, okay, let's do that 2 more times. And I just doubled down after that, like every 3 months and stuff. And I was hooked at that point. I said, well, this is it. This is perfect. I mean, I have more money now than I had when I started, and I have an asset that's cash flowing now. This is crazy. And so I was investing in that. I mean, I'm getting to your question about how I got started in Turnkey, because up to this point, I was just thinking about me, my family, building multi-generational wealth, and things were working great. But we had done all kinds of different businesses, and a lot of our friends and family were saying like, "Hey, what are you guys doing now?" And says, "Oh yeah, we're investing in Memphis in real estate." And it was just like, "What? What are you doing?" Like, yeah, we have like rental houses in Memphis, and there's just their mind kind of exploded at that point, because like, why Memphis? Where is that coming from? Single family rentals. You're doing real estate, and it was just like, people were like, tell me more about that. So and then so that's when we kind of like started talking more about our investment to our network, to our people, the people that we knew. And then they said, well, oh, I want to, can I join, like somehow invest with you in some deals? So we started doing joint ventures. We started to do private money lending. We started to sell these properties to people after they were all done. And this is when we said, and maybe we have a business here. Maybe we can do like turnkey rentals and then build a website and show all the properties and all that kind of stuff. And that's kind of how we got started, like, you know, seven years ago. That's when the turnkey started. Sorry, that was a long answer. That's probably
That was good.
That was good, and I appreciate the background. And so Memphis is kind of where you started. What markets are you guys currently in? What offerings do you have right now?
Well, Cleveland, St. Louis, Detroit, and also a few other places in Ohio, like Cincinnati is a great market. You know, Akron is another great market. A couple of so it's a couple of markets like that. But really, like Detroit, just outside Detroit, kind of like up and coming neighborhoods. There, I know a lot of people don't really want to invest there, but it's some great areas to invest in. So.
What is it about Detroit or Michigan that you're seeing there? I don't hear a lot of people talking about Michigan.
That's why.
Because nobody's talking about it.
You want to be in a boarding market. No, you want to be people that it's not on the radar, right? So people are not investing there. There's like, oh no, I don't want to invest in Detroit. High crime, stuff like that. But high crime, you can look at high crime in the whole city and say, yeah, it's relatively high crime. But there are different areas, neighborhoods. There's very low crime, great neighborhoods, working people, and all of that. And there's a lot of great businesses in Detroit that that employ very good people. So that, and we get, because not the investors are not looking at this, then we get better prices. We can get better deals.
So kind of in that turnkey space, right? Things are changing, right? Interest rates have been going up. The economy's changing a little bit. Eric, why, if someone were to ask you, what's a few reasons why turnkey is still a good, viable option right now?
Yeah, I think especially when you look at inflation. So we want to protect our purchasing power, and when you have a high inflation, like 7-8%, this is really eating away at your purchasing power very rapidly. And one of the best ways to protect your purchasing power is to invest in real estate with leverage. And I have some kind of metaphor that I use for kind of illustrate that, is that if you have like let's say you have like $25,000 today, and you go to Starbucks or your favorite coffee shop like Pete's, and then you can buy 5,000 cups of coffee at $5 each. If you look 5 or 10 years down the road, I think 5 years down the road, and with a 5% inflation rate, you will be able to buy only 3,300 cups of coffee, or 3,400 cups of coffee roughly. That's a lot less caffeine in your body that you need. So I know it doesn't seem like much, like 8% or 5% inflation, but it's really eating away at your purchasing power. You're going to be able to buy a lot less just 5 years down the road. And the thing is that when you invest in real estate, you invest that same amount of money in real estate with leverage. You have to have a mortgage. What happens, even if the inflation is, we can talk about inflation in an interest rate, in a moment. But if you buy that property today, you put that $25,000 down, $5,000 goes to fees, and you have like $20,000 down on that property. You rent it out and stuff like that. In 5 years from now, you're gonna have about $20,000 of net cash flow accumulated. You're gonna have about $20,000 in appreciation of the property, assuming only like 3% appreciation. And and you're going to have an equity pay down. Your tenant is paying your mortgage, your principal every month. And that's another $15,000-$20,000 right there. So just these three elements, that's $60,000 of value of equity that you have in 5 years. So you'd be able to buy even more than 5,000 cups of coffee 5 years down the road. You'd be able to buy close to 10,000 cups of coffees 5 years down the road by investing in a rental property over 5 years with a mortgage. So that's the power of that. A lot of people are saying, well, the interest rate is so high now, maybe I'm just going to wait. The interest rate is not high. And right now we're seeing the interest rate is going to come down, is coming down a little bit. The mortgage rates are coming down a little bit. And I think that it's kind of going to go sideways, I think, for a little bit. Either going down, maybe going up a little bit, up and down like that. And the reason for this is that if you look at since the 1980s, the average interest rate since the 1980s has been around like 7%, 7.75%. So the interest rate is not that high right now. It's still not to that level. And 7.75% is not, it's nothing outrageous. When I bought my first house in the 90s, early 90s or late 80s, I paid like 14% interest rate. That was my mortgage rate. And I survived. It was good. And I thought it was a good deal. So right now, the people are looking back at last year or 2 years down the road and say, oh yeah, my mortgage was like 3.5% or blah, blah, blah. Yeah, but that was because we were in trouble. Everything was artificially low. And now we're getting back into normal interest rates.
Okay, perfect. Now, a lot of people, you wrote a blog saying that now is very different than 08.
Yeah.
You mind kind of explaining the differences? Because a lot of people are scared and are worried we're going to have another 08.
Yeah, and I think the big thing is really about the situation in 08 was really about the subprime lending, which was they were basically lending to people that really shouldn't have been able to borrow that kind of money. And then there was also a lot of these mortgages, they were extremely low. The interest rate was extremely low at the beginning. And then 2 or 3 years later, then they would bring them back to the market rate, right? And then the Fed started increasing the interest rate at that point. And then, so when it was time to renew these mortgages, then all of a sudden, a lot of people were, instead of paying, $1,000 a month in mortgage, now they had to pay $2,500 a month. They could barely afford $1,000, and now all of a sudden their mortgage payment doubled or more than doubled. So we ended up with a lot of people that were, they couldn't afford the loans that they signed up for, and we had a ton of foreclosures. And I think a lot of people are expecting that in this market. They think that there's going to be a lot of foreclosures and blah blah blah. And I don't see that, because the borrowers that we have today, they're solid borrowers. The rules have changed since 2008, and there's a lot more vetting and validation of the lenders that we didn't have in 2008. So the borrowers that we have, they're solid. They have good credits. They have good jobs, and it's not going to be the same. You're not going to have massive number of people that are going to be foreclosed upon. I don't see that at all. We might end up in a situation where we hit a recession, unemployment is going to go up. I think even unemployment right now, I think is too low.
Yeah, very low.
Up, right. So everybody knows that, and I think it's going to go up. But I think there's still a lot of jobs out there. We keep hearing Amazon is going to get rid of 18,000 employees and all that kind of stuff. And I think a lot of those were kind of like to feed their growth, So it was not so much to just to operate. It was just we were growing so fast, and now we're not growing so fast anymore. So these people, we don't need them anymore. So, but there's still a lot of jobs out there. So I still don't think we're going to end up in a situation where the unemployment is going to go to 12%. And then, everybody's going to, I can't afford my house anymore. I don't have money, blah, blah, blah. And then I have to get rid of my house, sell my house and stuff like that. So in that situation, I don't think we're going to end up there, but if we end up in that situation where the recession is so bad that unemployment is going to go through the roof, then maybe we're going to have a little bit more supply on the real estate market.
Mm-hmm.
But I honestly don't see it. I think the unemployment will go up. That's for sure. But I don't think it's going to go up to a level where, it's going to be a, terrible recession where, everybody's going to have to sell their house because they can't afford it.
Yeah. Eric, you've got a ton of good resources, one of them being the blog that we referenced. And if anybody's looking for that, you can find it at martelturnkey.com.
Yeah.
But you've also got a book, Eric, right?
Yep.
Stop Trading Time for Money.
Yep.
Tell us a little bit about that. What can somebody find when they grab that book?
Yeah, so that book is really it's really a blueprint for achieving financial freedom and building a legacy for your children. So I really did a lot of introspection and analysis of like why am I where I am today? And I really kind of had to look back. I was working with an editor, and she was asking me like a million questions about things, but why did you do that? And it's like, and I said, why did I do that? And so there's a lot of introspection. There's a lot of reflection about kind of like why I am where I am today. And I tried to really like codify it and build a blueprint for people to follow what I have done, and so that they can be successful as well. Part of it is about the mindset, definitely. Having the right mindset and figuring out where your blockers are, and then the rest of it is about finding the right strategy for you. And really, we talked a little bit about it, but about kind of like time commitment and resources that you have, and then we can also look at the capital that you have to invest. But these are things. All these things have to be aligned. If if your goal is to achieve financial freedom, you have to find strategies that are going to get you there. And a lot of people are looking for shiny objects and all that kind of stuff, instead of focusing on the right strategy that's going to give them the passive income they need. And then on top, below that, to support that strategy, well, you have to have the right time, you have to have the right resources, the right skills, the right amount of money, and you have to do that in the right market in order to support that strategy. And only then can you be successful. And that's what I see when I talk to investors that are struggling. That's what I'm seeing, is that there's something that's not aligned with their strategy. They either underestimate the amount of time that's needed, underestimated the amount of money that's needed, or they're in the wrong market. They're trying to do single family turnkey single family rentals that are cash flowing, let's say in California or something. So yeah, they have low returns. So that's and and I'm hoping that by the end of the book, someone could really look at it, and it's really a blueprint, and then being able to do at least one transactions using the book, and then just keep going at it.
Awesome. You've got that flip system as well. What's right? Tell us a little bit about that.
So part of it, a lot of the people that I talk to and stuff like that, they want to kind of do what I'm doing, what we're doing with Martel Turnkey, or they want to do like a BRRRR strategy, which is to buy a distressed property, renovate it, rent it out, refinance it, and repeat with. And so we thought, okay, well, maybe we can just kind of like put all of this together for people that want to do that, to replicate what we're doing. So we're literally packaging the training. We're training them on what they need to do, what they need to know. We are aligning them with a coach, a success coach, someone that's going to really guide them through the process. I've seen so many programs out there. All they do is like online training. It's how I do the online training, and they train you on everything. They train you on multifamily, they train you on self-storage, they train you on the mobile home park and all that kind of stuff. And but nothing cohesive. So we're training you on things that are specific, and we're also going to coach you and guide you on that specific strategy that's going to work for you. And we're bringing together all the other resources that we have. So team on the ground. So we have an acquisition team as well. We're going to provide deals for you that are going to work, and that we're going to help you put the offer together. And we're going to we have a system. We're going to give you access to a custom CRM system where you're going to be able to treat all the financials are in there for to do the calculation, whether to determine if it's a good deal or not, and then track all the activities associated with that deal, like the constructions, all the contracts, and all that kind of stuff. So that's the whole package, the whole flip system package. We want you to be successful. This is how important this is. So we're putting everything in that.
Awesome, Eric. And where can they find that? Can they find that at martelturnkey.com as well?
So that you can go on flipsystem.com.
Okay. We will have all those links in the show notes.
Awesome.
Yeah.
Eric, really appreciate your time today. Man, you've shared a ton of good information with us and with our audience. Thank you.
Oh, my pleasure.
Go make it a fantastic day.
Take care.
And feel free to follow me also on Instagram if you want, Eric Martel Official.
Boom.
Perfect.
Awesome. Okay. Awesome. Thanks, Eric. Let me end the broadcast. Okay. Man, that was some good stuff. Thanks for sharing your story.
I hope I stayed coherent for the most part.